What if there's a way to invest? Known for simplicity, low fees, a great track record, and it could potentially make you a millionaire. Guess what? It exists. A lot of people are hesitant when they start investing. They know they should, but they're hesitant because once they do pull the trigger, they quickly realize to invest in the stock market, you have to find stocks to buy. And so maybe you decide to learn how to value stocks, but there's one problem. There's a lot to learn. You've got to master the income statement, the balance sheet, the statement of cash flows. Then you've got the ratios. You've got to learn the price to earnings ratio, forward price to earnings ratio, price to book ratio, price to sales ratio, EV to EBITDA, yields, dividend yield, earnings yield. Once you've mastered those ratios, well, you still have to learn valuation. You got to do discounted cash flows. And then let's say finally, you can put all of your skills to the test and start buying stocks. Or you just do this. This is a super simple portfolio. You only need to make 3 decisions. It's way easier than buying a car, even a vacuum cleaner. Not again. Think of the 3-fund portfolio like a symphony orchestra, each with its own unique instrument and its own unique role. Let's start with the string section. This consists of violins, violas, cellos, double basses. These instruments provide the foundation and melody, just like stocks in the portfolio, offering growth and potential returns. Now, the second fund represents the brass and woodwind section. These instruments, they add depth, they add texture, they add stability to the sound of our symphony, just like the bonds in the portfolio. You see, bonds, they add income and they act as a force of stability during times of economic turmoil. And our third fund represents the percussion section. The drums, the cymbals, the rhythmic instruments. Just as percussion instruments bring rhythm and energy to a symphony, international investments in the portfolio provide diversity and global exposure. They add a dynamic element, allowing you to balance risk and seize opportunities in markets outside the United States. Now, usually only a highly skilled conductor would be able to lead an orchestra like this. But guess what? I have absolutely no idea what I'm doing. I'm literally just going like this. Maybe I fooled you. Probably didn't. But that's the good thing about this, because you don't have to be a highly trained conductor to try to figure this whole thing out, like a financial advisor might have to do helping people manage their investments. This is so easy. You can do it on your own, and that should be music to your ears. When you have those 3 sections of your symphony, when you have this 3-fund portfolio already, you're gonna have all of these different stocks. I couldn't even fit all of the stocks that are inside this portfolio on this piece of paper because there's so many. There's over 8,400 stocks that you'll have access to when you have a portfolio like this, and you're gonna have over 10,000 bonds. That's a crazy amount of bonds, right? So think about how easy it is to just make a few decisions and get this thing set up, or you have to go value and find and search through all of these different stocks to try to figure out which stock you want. This is so much easier. Now, I'm gonna go over the returns that this could have earned you. So let's say you had invested $10,000 or $100,000, what would it have grown to? And I'm also gonna go over the different decisions you need to make to set this thing up. It's really easy. But before we get there, let's talk about risk. Imagine our string section. Let's say we only have 1 cellist in our string section, and that cellist somehow accidentally broke their cello. It shattered into a million pieces and they can't use it anymore. Well, they have a backup cello, and so that's mitigating their risk, right? And same kind of thing goes with stocks. If you own 1 stock in your portfolio and that's it, well, there's a lot of risk. If that 1 stock goes out of business, you lose 100% of your money. But if you have 100 stocks and only 1 goes out of business, that's only 1% of your portfolio. So we want to have diversification. We want to have more than 1 cello, if that makes sense. So for our 3 funds, we have stocks, domestic stocks, so US-based companies. We have international stocks. These are stocks that are not inside the US. Then we have bonds. Those are the 3 different funds that we have. The way we decide if we're going to be more aggressive or more conservative in the decision you have to make is, do you want to have more bonds or do you want to have more stocks? Say you're younger. Well, then you might want to have 10% in bonds. So a very small amount. And the rest of it's going to go into stocks. US stocks, international stocks. Or maybe you're on the other side. Maybe you want to be more conservative. Maybe you want 30% in stocks only, and then the rest, the 70%, is going to go into bonds. So if you want to make a decision about how aggressive or not aggressive you are, here are some potential allocations that you could have. Go ahead and pause the video here if you want to take a look, but we're going to move on. Now we have to make a decision. Do you want ETFs or do you want index funds? I have a video. Take a look at my video on that if you want to see the differences if you don't know, but we got to decide which one to go with. So that's up next. So you can use different fund companies for this. I'm gonna show you Vanguard. You could use Charles Schwab, you can use Fidelity. I will put links to videos I've made on those below, but we're gonna talk about Vanguard here. So first off, index funds. So index funds for Vanguard, you have 3 different index funds that you can use. Vanguard Total Stock Market Index Fund, VTSAX, Vanguard Total International Stock Index Fund, VTIAX, Vanguard Total Bond Market Fund, VBTLX. Those are the 3 index funds. If you prefer to have ETFs, you can go with Total Stock Market ETF, VTI. You could go with Vanguard Total International Stock Index Fund, VXUS, or you could go with Vanguard Total Bond Market ETF, BND. Here comes the juicy stuff. We're gonna talk about the returns. So let's say you invested in the aggressive portfolio and you had 90% of your money in the stocks and 10% in bonds. We're gonna measure this by going back to January of 2002 until April of 2023. What if you invested $100,000 and you held over that period of time? We have 70% in US stocks, we have 20% in the international stocks, we have 10% in bonds. So $100,000 would have grown to $489,000 over that time period. This is a 7.72% annual rate of return. So the question is, what type of roller coaster do you want? Do you want a more aggressive roller coaster? You're gonna have a bunch of drops, you're gonna have some loops in there, right? Or do you want just like a baby roller coaster, right? Just something really easy, you're not going upside down or anything like that, it's not going too fast. That's gonna be a more conservative portfolio. But you're not gonna get as far with a conservative portfolio as you will with aggressive portfolio over the long term. Let's compare this to a more moderate portfolio. Let's say we had 35% in US stocks, 25% international stocks, and then 40% in bonds. That's gonna be a much more conservative or moderate type of portfolio. So this more moderate portfolio, instead of growing to 489,000, which our more aggressive one grew to, this would grow to about $360,000. So yes, you got further going with the more aggressive portfolio, but there was more volatility. There was more turbulence along the way. So last, if you want to get to $1 million with that 3-fund portfolio, with the aggressive portfolio, if you made 7.72% every single year for 27 years, you would have to invest $12,000 every year to get there in 27 years. Now, if you wanted to get there in 20 years instead of 27 years, you would have to invest $20,000 every year at 7.72%. So over time, as long as you invest a correct amount of money, you can really build up a nice size portfolio by using a 3-fund portfolio. You just have to have enough time and enough money going into it every single year to get to where you want to get to. So 3-fund portfolios, they're cheap, they're easy to handle, they're diversified. All you gotta do is rebalance your money and keep the correct allocation every year. Now, 3-fund portfolios may or may not be right for you, and there actually might be a better option. And if you wanna see the difference between that option and a 3-fund portfolio, you're gonna wanna watch this video right here.